So I'd like to welcome David Garofalo, Chairman and CEO of Royalty Corp. David was named Mining Person of the Year in 2012 by the Northern Miner. He was also Canada's CFO of the Year by Financial Executives International Canada 2009, Top Gun CFO by Brendan Wood International, and he was recognized by IR Magazine for Best Investor Relations by a CEO in 2011. David is kind enough to once again join us from Vancouver. David spoke to us. I don't know if you remember, David. It was back in February 2023. And once again, I'd like to welcome to the show David Garofalo. Welcome, David. Oh, there he is.
Hi, Alan. Thanks so much for having me on again.
My pleasure, my pleasure. And as always, a great hot topic. Again, where a great guest yourself coming to us to talk to us about the latest hot topic, whether it's Bitcoin or whether it's gold, both things surging tremendously in the markets over the past, past bunch of weeks anyways, maybe even the last few months. And I thought we'd start off by, asking just a basic question. And you and I were talking off air before the show about this already. And I thought for the viewers, I'd start off by asking you, why would anyone be buying gold today or at any time? Is it truly a hedge against the US dollar? We hear all the time that gold is a hedge against the US dollar. If the US dollar were to falter, that's when gold does the best. If there's chaos in the world, gold does the best. But I always bring the point up, is it really a hedge against the US dollar? If the US dollar were to falter, I think everything would falter with it, right? The US economy, largest economy in the world. 20% of the world's wealth flows through its borders. If the US economy and the dollar were to go down, would it matter that you're sitting on a whole bunch of gold? And what investor actually has enough gold in their possession to balance or hedge against a faltering US dollar? So I ask you the question, why would anyone be buying gold today or at any time?
Well, it's not only a hedge against a faltering US dollar, but against fiat currency generally. So if you look at all the currencies in the Western world, we've seen a significant devaluation of those currencies really since the great financial crisis, if not before. There's been a massive expansion of money supply. And gold is an accurate barometer of what that does to inflation. As you expand money supply, the cost of hard goods go up. And we've seen that. We've been in the midst of an inflation cycle unlike anything we've seen since the 1970s. So if you look at gold as a hedge against the devaluation of paper currencies, it's done exceedingly well in the long term and in the short term. If you look at when gold was decoupled from the US dollar back in the early 1970s, the US government abandoned the gold standard. Gold at that time was $35 an ounce. Today, it's about $2,200 an ounce. The purchasing power of a US dollar has gone down over 90% since that time. So gold has been a very effective hedge. It's the one true currency that can't be printed, can't be expanded in supply willy-nilly like fiat currencies. The only limit to paper currency is what the printing press can spit out. And that's what we've seen really occur over the long term. Most recently, we saw a pickup in inflation as a result of the excesses introduced into the financial system since the great financial crisis and even before that, as a result of expanding money supply. COVID was kind of the match that lit the dry forest, if you will, that kind of resulted in inflation finally rearing its ugly head. It's something we've been calling for a number of years, and finally we saw the evidence of that most recently as a result of the COVID crisis.
It's invalid points, obviously, with respect to gold and why and who should be buying it and why they're buying it. The economy has changed a lot since you and I got together last. I have some interesting statistics here. Inflation, when we spoke, I believe it was February 8, 2023, inflation was 6.3%. Today it's 2.9. Unemployment was around 5%. Today it's 5.7%. Gold was roughly $1,860 an ounce. Today, as you said, getting close to $2,200. Predictions of an approaching recession were out there, but yet we really never fell into a recession. How has the gold market adjusted to these conditions over the past year? And what's been spurring on the gold price primarily over the past year? Something to making it different than where it was sitting a year ago.
Well, the unfortunate truth is that headline inflation numbers actually vastly understate the reality on the ground. None of us are experiencing 2 to 3% inflation or even 4% inflation. If you're putting food in your stomach, fuel in your car, a roof over your head, you're deeply into double-digit territory. Mortgage payments have gone up 70 to 80%, monthly mortgage payments as a result of the increase in interest rates. So we are all experiencing a significant devaluation of the purchasing power of our currency. And the headline numbers unfortunately understate that. They lull us into a false sense of complacency. Gold is an accurate barometer of what inflation really is. And interest rates are not positive. They are on a nominal basis. They have gone up on a nominal basis quite dramatically. But on a real basis, when you consider real inflation on the ground, which I believe is double digit, and many prognosticators in the market believe we're likely in an entrenched inflation cycle for quite a period of time, we're actually into negative real interest rate territory. So if you own a treasury bill, whether it's in Canada or the US, you're actually seeing your purchasing power, even with nominal interest rates approaching 4 or 5%, actually going down. So it's eating away at your purchasing power, even as you think you're enjoying a higher interest rate, because real interest rates are dramatically negative and likely to accelerate deeper and deeper into negative territory. That means the opportunity cost of owning gold, which is really a financial instrument. It's a currency. It's not a commodity in the strictest sense of the word. That the value of that is going up because the opportunity cost of owning it isn't there. And currencies trade relative to each other based on relative interest rates. So gold, yes, yields zero, but treasury bills are yielding negative on a real basis. And that's what really is driving capital into gold.
You make a good point. Gold not being a commodity, it's a currency because really, what do you use gold for other than wearing it around your neck or on your wrist? It's not doesn't really have any use industrial or manufacturing. So yeah, I think gold should be looked at as a currency. JP Morgan recently talked about gold reaching $2,300 an ounce by 2025. What do you think about that prediction? And do you think this prediction has anything to do with the fact that they believe central banks or let's say the Fed in particular will be cutting rates the second half of this year?
Yeah, I think that is a function of that exactly. So it goes back to the point I just made about interest rates going down deeper into negative territory. And the central banks are pivoting, in my view, prematurely because I think inflation is much worse than headline numbers tell us. And so if they pivot early, what will happen is you'll start to see a flow of capital out of, accelerating flow of capital out of treasury bills into gold and commodities and hard assets generally in order to protect against inflation. So hard assets are finite in quantity, paper is infinite in quantity. Again, the only limit is the printing presses. So I think that's really what's going to be driving capital into gold and other commodities in the foreseeable future. And the reason that the Fed has to pivot is not because inflation is slain. It's because debt levels are at exorbitant levels relative to where they were in the last big inflation cycle in the 1970s. Global debt to GDP today is a remarkable 350%. Global debt to GDP in the 1970s was only 100%. So there was a lot more latitude at central banks in order to increase interest rates to tame inflation. And we saw interest rates go to 20% and above back in the early 80s in order to tame inflation numbers that were 14, 15%. Central banks do not have the appetite to do that because the debt levels are unserviceable at that level. For example, in the US, debt service has doubled in the last 18 months to $1 trillion per year. US federal government debt service. That's one out of every $7 of taxes generated in the US. If interest rates stay at these levels for another couple of years, as these treasury bill rates reset, it could double again. It's unsustainable. So effectively, the central banks have to inflate their way out of debt. They have to grow the economy through inflation so that debt to GDP goes down as a result of that inflation. That's the only fiscally responsible way for them to repay the debt, unfortunately.
Yeah, it, I guess puts even more emphasis on the election coming up at the end of the year. The new administration, what they're going to do, and a lot of people are talking about that. 34 trillion in debt, I believe, is the number, and so it's definitely a problem, especially with higher interest rates. Over the past, well, many years, but especially in the last year, the Chinese central bank, they've been purchasing a lot of gold, and we hear obviously central banks buying a lot of gold from various countries. Do you think they're going to, they can keep up the buying? And I guess a second part of that question would be, other than central banks, who else is doing the buying right now? Is it primarily central banks, or are there other bodies that are looking at buying more and more gold going forward?
No, your comment on the Chinese central bank is quite apt. They are the biggest consumer of gold. And I'm not just talking about the central bank, but China generally, because it's a deregulated market. Individuals can own gold, and they have an underlying mistrust of their fiat currency as well. So we're seeing consumers in China, central banks in China, consuming gold at unprecedented levels. And they have become the biggest importer of gold in the world, eclipsing India, which traditionally has been, because of the wedding culture there and the value of gold to the wedding culture being a big source of demand longer term. China has eclipsed that. And China is not only the biggest consumer of gold, it's the biggest producer of gold in the world as a country. And so they're consuming everything they produce and also importing more than any other country in the world. And the reason they're doing it is because China is an export-oriented economy. It's the biggest export-oriented economy in the world. So they're dealing with an avalanche of foreign currency proceeds, particularly the US dollar. And they see the writing on the wall in terms of the devaluation of that currency. And they're diversifying their central bank reserves as rapidly as possible. And now that individuals can buy physical gold readily on the various exchanges within China, they're diversifying out of their fiat currency as well in order to protect the purchasing power of their savings.
So I guess to sum it up, for investors that are watching our show, because it's obviously an investment show, and that's investors are watching right now. If someone were to want to add gold to their portfolios, what would you say, or what would you recommend? Would you own gold certificates, so gold itself, or would you be buying gold stocks, the miners themselves? Obviously, there are risks or pros and cons to both, but what would you say as an investor? Where would you be investing your dollars?
Well, the lowest risk way to do it is to just buy physical gold. You can buy it at a bank, or you can buy the ETFs that are physically backed by gold that are major exchanges like the NYSE. But if you want leverage to the gold price, you want to look at equities, because they provide leverage in terms of profitability as the gold price goes up that exceeds the percentage increase in the gold price. That's the beauty of having that kind of margin. Unfortunately, the producers have underperformed the commodity for a number of years, and there's been a huge divergence between share price performance of the equities, the operators in particular, and the gold price because of the overhang of cost inflation. So the inflation we're all experiencing in the general economy, the miners are not immune from that. So if you're running a mine, you're dealing with labor inflation, energy inflation, input cost inflation generally. So that's weighed on their margins and weighed on the leverage to the gold price. So after 33 years of building and operating mines, I decided when I came back into the gold sector after having merged Goldcorp with Newmont back in 2019, that I didn't want to run an operating company. I wanted to run a royalty company that had top line exposure at the mine site, which completely insulates you from input and capital cost inflation at the mine site. So we get a percentage of the gross revenue, and we get leverage to the exploration success of the operators that run the mines. As they drill out their deposits, we don't contribute to those exploration budgets, but we get the benefit in our royalty portfolio as those reserves grow. To me, that's the optimum place to get the best leverage of the gold price and leverage the exploration without actually having to pay for it.
David Garofalo, Chairman and CEO of Gold Royalty Corp. I want to thank you once again for coming on our show and talking to us about gold and shedding some light as to why gold has really taken off and where you see things going over the next couple of years. There's no doubt price of gold continues to rise, and many are calling for the price of gold to be a lot higher in the not so distant future. So thank you again, David, for being on the show.
Thanks, Alan.
All right, all the best. Take care.